In 1950, the United States Treasury quietly began writing checks to a desert kingdom that on paper was one of the poorest nations on earth. By 2024, that same kingdom's investment fund owned pieces of Uber, Boeing, Disney, Electronic Arts, Live Nation, Newcastle United, and enough of the PGA Tour to force a merger on its own terms. That's not luck. That's not oil money spent on toys. That is 74 years of a single unbroken strategy, and by the end of this video you will understand exactly how a country the West thought it had trapped in economic dependency ended up holding leverage over the American financial system itself. Here's the myth you've been sold, that Saudi Arabia got rich because it got lucky. Sand, then oil, then billions, end of story. A kingdom of chance. Here's what the paper trail actually shows. Every single major concession Saudi Arabia has ever made to the West: the 1933 oil deal, the 1950 tax agreement, the 1974 petrodollar pact. Even the 2019 Aramco stock sale was structured at the negotiating table to convert short-term dependency into long-term control. This is the story that oil documentaries don't tell you because it isn't about oil. It's about how you take a weaker hand and, over 3 generations, quietly turn it into leverage over the strongest economy in human history. Stick around because Chapter 4 gets into territory most people have never even heard of: a 2026 collapse that nobody in mainstream financial media wanted to cover properly. Let's go back to the beginning. Abdulaziz ibn Saud has just unified most of the Arabian Peninsula. Under his rule, after roughly 3 decades of near-constant warfare, he is sitting on a treasury that is functionally empty. His main source of income is pilgrimage fees from Mecca, and the Great Depression has gutted even that. And he is surrounded. To the north and east, the British Empire controls Iraq, Kuwait, and the Trucial States. The French hold Syria and Lebanon. Britain has already installed and deposed monarchs across the region like pieces on a chessboard. If you are Ibn Saud in 1932, the single greatest threat to your survival is not poverty. It's British and French colonial ambition creeping toward your borders. So when geologists suggest there might be oil beneath the eastern province, Ibn Saud faces a choice that history books usually flatten into: he needed the money, but look at who he actually chose. He didn't go to the British, who already dominated Middle Eastern oil through the Anglo-Persian Oil Company and Iraq Petroleum Company. He went to a California-based firm, Standard Oil of California, SOCAL, a company with zero colonial military footprint in the region and critically backed by a government that had shown no appetite for building an empire in the Gulf. In 1933, Ibn Saud signed a concession agreement worth roughly 50,000 British gold sovereigns up front, with more to follow. On the surface, this reads exactly like every other colonial-era resource. Grab. Desperate ruler, cheap sale, foreign company walks away with the prize. But flip the lens for a second. What Ibn Saud actually did was import an American corporate presence as a geopolitical buffer. Standard Oil of California, soon to become the Arabian American Oil Company Aramco, had every incentive to lobby Washington to protect Saudi sovereignty, because Washington protecting Saudi sovereignty protected Aramco's asset. He wasn't giving away his country. He was hiring a private security force that happened to be disguised as an oil company, paid for by its own profits, backed by the most powerful government on earth, one that, unlike Britain, had no direct territorial designs on Arabia. That's move number 1, and it barely gets mentioned in most retellings. The concession wasn't just a sale. It was a deliberate insertion of American commercial interest into the region as a counterweight to British and French colonial pressure. Now fast forward to 1950, and this is where the story gets genuinely wild, because what happened next is a masterclass that modern corporate lawyers still study. By the late 1940s, Aramco is pumping serious oil and making serious money, and Ibn Saud can see it. He can also see that Venezuela's oil minister, Juan Pablo Pérez Alfonso, has just negotiated a 50-50 profit split with Standard Oil of New Jersey and Shell. So Ibn Saud does something extraordinarily direct. He threatens to nationalize Aramco's entire operation unless Saudi Arabia gets an equal share of the profits. This is a real threat, and Aramco knows it. Losing the concession outright would be catastrophic for the 4 American oil giants, SoCal, Texaco, Standard Oil of New Jersey, and Standard Oil of New York, who by now jointly own the company. So Aramco's lawyers go looking for a way to give the Saudis their 50% without actually costing the American shareholders 50%. And they find one, buried in the US tax code, the foreign tax credit. Here's the mechanism, and it is almost too clean to be real. If Saudi Arabia levies an income tax on Aramco's profits, and the United States recognizes that as a legitimate foreign tax, then, under US law, Aramco can deduct dollar for dollar whatever it pays to Riyadh from what it owes the US Treasury. So in November 1950, the Saudi government passed a new corporate income tax law. Aramco agreed to pay it. And because of the foreign tax credit, every dollar that flowed to the Saudi Treasury was a dollar that would otherwise have flowed to the US Treasury. The oil company's actual out-of-pocket cost barely changed. The burden was quietly transferred from Aramco's shareholders onto American taxpayers. Internal State Department correspondence from the period, memos you can still find in the Foreign Relations of the United States Archive, shows Treasury officials were uneasy about this from day one. One 1953 memo from the Assistant Secretary of State flatly states that the net transfer from the U.S. Treasury as a result of this arrangement was running at roughly $200 million a year, and this is $1,953, worth well over $2 billion in today's money, every single year quietly rerouted from the American tax base into the treasury of a King Washington had never directly subsidized before. It became known, half-jokingly, inside Treasury as the golden gimmick. And notice what actually happened here. Ibn Saud didn't just get his 50%. He got Washington's own tax code to fund his domestic state building, palace construction, tribal payments, the early skeleton of the modern Saudi bureaucracy, without American diplomats ever having to justify a direct foreign aid line to Congress. The United States government became an invisible co-financier of the Saudi state, and most of the people paying for it had no idea it was happening. This is the pattern you need to hold on to for the rest of this video because it repeats at every scale for the next 70 years. Saudi Arabia does not confront Western power directly. It finds the mechanism inside the Western system itself, and it lets that mechanism do the work. Now, if you know anything about the history of oil nationalization, in the 20th century, you know it is usually a bloodbath. Iran, 1951. Prime Minister Mohammad Mossadegh nationalizes the Anglo-Iranian Oil Company. 2 years later, a joint CIA-MI6 operation topples his government. Libya, Iraq, Algeria, nationalization efforts across the region in the 50s and 60s were met with boycotts, sabotage, coups, or outright military threats. So here's the question that should be bothering you. How did Saudi Arabia end up owning 100% of Aramco, the most valuable single company on the planet, without a single coup attempt, without a nationalization lawsuit, without so much as a serious diplomatic crisis? The answer is that the Saudis didn't nationalize anything. They bought it, slowly, legally, one negotiated tranche at a time, over an entire decade using leverage they had built for exactly this moment. The first move came in 1972 and 1973, when Saudi Arabia negotiated what's called a participation agreement, an initial 25% ownership stake in Aramco's assets. This wasn't seizure. It was purchase, at negotiated terms, structured to be legally unimpeachable in international courts. Then, in the wake of the 1973 Yom Kippur War and the resulting oil embargo when Arab OPEC members cut off exports to the U.S. in retaliation for American support of Israel, Saudi Arabia used the moment of maximum leverage to push that stake up to 60%. Think about the position this put the American oil majors in. They could refuse and risk losing the entire concession outright, the way Iran's British stakeholders nearly did in '51. Or they could sell, gradually, at a price they negotiated themselves, while keeping their engineers, their technology contracts, and their operational role intact. They chose to sell, every time. By 1980, Saudi Arabia held 100% ownership of Aramco. No war, no expropriation, no frozen assets, no international arbitration case, no coup. The 4 American companies that had once owned the entire operation didn't get expelled. They got converted. Aramco kept nearly all of its American engineers, geologists, and refining technology as paid contractors and technical partners for decades afterward. The corporate colonizer didn't get thrown out. It got demoted on paper into a well-compensated employee. This is the detail that should genuinely unsettle you. The same. American companies that once held total control over the extraction of a foreign country's most valuable resource ended their run in that country not as conquerors but as vendors, selling engineering services to the very government whose oil they used to own outright. And the Saudis learned something in this decade that would define the next 50 years of their strategy. You do not need to fight the West's system to beat it. You need patience, cash flow, and a willingness to let the other side believe the negotiation is still in their favor, right? Up until the final signature. Compare this to what happened to countries that tried confrontation instead of patience. Iran got a coup in 1953 and later, decades of sanctions. Libya under Gaddafi's nationalization drive triggered years of Western hostility and eventual isolation. Saudi Arabia got full ownership of a trillion-dollar company and remained, throughout, one of Washington's closest allies in the region. Predatory compliance beat confrontation every single time. And by 1980, with full ownership secured, Saudi Arabia was sitting on the largest proven oil reserves on the planet, complete operational control, and a war chest of petrodollars that had already started flowing into a financial arrangement even more consequential than Aramco itself. This next part of the story has been so distorted by internet misinformation that we need to slow down and separate what's documented fact from what's viral nonsense, because the real version is stranger and more interesting than the myth. Here's the myth, which went viral in 2024 and is still floating around, that in 1974 the US and Saudi Arabia signed a single formal 50-year treaty locking Saudi oil sales exclusively into US dollars, that this treaty expired in June 2024 and that its expiration marks the collapse of American financial dominance. Multiple large outlets ran with this. It's mostly fiction. There was no single 50-year treaty. Saudi Arabia continued accepting British pounds for some oil sales well after 1974. There was no exclusive dollar mandate written into a formal pact. But here's what actually did happen, and it's more interesting than the myth because it wasn't a treaty. It was a trade. After the 1973 oil embargo quadrupled prices and rattled the American economy, Treasury Secretary William Simon, a former Salomon Brothers bond trader who understood capital markets better than almost anyone in Washington, flew to Saudi Arabia in 1974 with a specific narrow proposal. The U.S. would offer military equipment, training, and security guarantees. In exchange, Saudi Arabia would take its enormous and growing surplus of oil dollars and recycle a substantial share of it directly into US Treasury securities, funding American government debt. This arrangement, formalized through joint use Saudi economic and military commissions, established in June 1974, was kept confidential for over 4 decades. It only became public in 2016 when Bloomberg News forced its disclosure through a Freedom of Information Act request, and the number that surfaced was staggering. By that point, Saudi Arabia's disclosed holdings of US Treasury debt were estimated around $117 billion, built from a relationship that had operated quietly off the public record since a bond trader's handshake in the Nixon era. Now here's why this mattered so much more than a simple loan. Every year that Saudi Arabia recycled its oil surplus into American government debt, it did 2 things simultaneously. First, it helped the U.S. run sustained budget and trade deficits. Without the currency crisis that would have crippled almost any other country attempting the same thing, the arrangement French officials had already started calling America's exorbitant privilege. Second, and this is the part almost nobody talks about, it made Saudi Arabia's financial position and America's financial stability structurally inseparable. Think through the mechanics with me. If Saudi Arabia holds $100 billion, later hundreds of billions in U.S. Treasury bonds, and Washington ever seriously threatens the kingdom militarily or hits it with the kind of crushing sanctions regime it later used against Iran, Saudi Arabia has a nuclear option sitting quietly in its own portfolio. Sell. Dump a meaningful fraction of those treasury holdings onto the open market fast enough, and you don't just hurt Saudi Arabia's own portfolio. You spike U.S. borrowing costs, rattle bond markets already nervous about American debt levels, and hand every rival of American financial hegemony a live demonstration of vulnerability. This is what analysts mean when they say Saudi Arabia became too big to fail in the eyes of Washington, not because anyone loved the kingdom, but because the two economies had become mutually hostage to each other's stability. The US didn't build a cage around Saudi Arabia with the petrodollar system. It built a bridge that could be burned from either side. So the Saudis made absolutely sure they were standing on the end of it with the detonator in hand. You can see this leverage exercised in miniature moments throughout the following decades, every time Washington has pushed too hard on human rights, on OPEC production quotas, on the Khashoggi killing, on anything. And the Saudi response has, again and again, hinted at the same quiet reminder: our money is still sitting in your bond market, and our oil is still priced in your currency. Don't forget who's structurally load-bearing here. By the time this arrangement's original economic cooperation framework quietly lapsed from active renewal around 2024, the fact that got so badly distorted into the petrodollar died clickbait, the underlying relationship it had built no longer needed the original paperwork. Roughly 80% of global oil transactions were still dollar-denominated. Decades of financial entanglement don't unwind because one bureaucratic renewal clause goes quiet. The dependency the West thought it had engineered had become, by any honest reading of the numbers, mutual. And mutual dependency, when one side is patient and the other side is reactive, eventually tips. Which brings us to the era of Crown Prince Mohammed bin Salman, and to what might be the single most audacious financial maneuver in this entire 70-year arc, taking the old economy wealth of oil and converting it, at scale, into ownership stakes in the new economy that the West itself is built on. The centerpiece of this pivot was the December 2019 Aramco IPO. On the surface, this reads like Saudi Arabia inviting Western capital in to buy a piece of its crown jewel, the standard dependency narrative interpretation. Look closer at the mechanics and the story flips entirely. Aramco floated just 1.5% of the company. Not a majority stake, not even close, a sliver, deliberately small, on the kingdom's own Tadawul exchange rather than New York or London, avoiding the intense American legal disclosure requirements that international investors had been pushing for. That 1.5% raised $25.6 billion at a valuation north of $1.7 trillion, briefly touching a $2 trillion market cap on day 2 of trading, making it, for a period, the most valuable public company on Earth, ahead of Apple and Microsoft. Combined valuation gaps aside, the genius wasn't in going public. It was in exactly how little control was actually sold. 98.5% of Aramco remained firmly in Saudi state hands. What the IPO actually did was convert a portion of illiquid oil reserves sitting in the ground into liquid capital that could be redeployed anywhere on Earth instantly, without giving up governance of the company generating it. And the destination for that capital was the Public Investment Fund, the PIF, which by the end of 2025 held preliminary assets under management of roughly $910 billion, having grown from around $223 billion in 2017 to nearly $1 trillion in under a decade. That is one of the fastest asset accumulations by any investment vehicle, public or private, in modern financial history. Look at where that money actually went, because this is where Saudi Arabia buying influence stops being a talking point and starts being a documented map of the future economy. In 2016, PIF anchored SoftBank's Vision Fund with a $45 billion commitment, becoming, at a stroke, one of the largest single forces behind the entire modern venture capital ecosystem, indirectly shaping the fate of companies from DoorDash to dozens of AI startups that never would have scaled without that capital base. Direct positions followed. $3.5 billion into Uber, over $9 billion cumulative into Lucid Motors, betting on the electric vehicle transition itself. A portfolio that reads less like a sovereign wealth fund and more like an index of the companies that define 21st century American cultural and technological life. Then came sports and entertainment, and this is where the strategy gets almost impossible to ignore because it plays out on television screens every single week. In 2021, PIF took an 80% controlling stake in Newcastle United, one of England's most storied football clubs, for roughly $300 to $400 million, a rounding error for the fund and a permanent foothold in the cultural infrastructure of English football. Then Live Golf, a breakaway tour funded with a reported $1 billion just to poach superstar players away from the PGA Tour, backed by a fund PGA Commissioner Jay Monahan himself admitted in internal communications the tour simply could not outspend by 2023 rather than continue an expensive legal and competitive war. The PGA Tour agreed to merge with LIV under PIF's financial umbrella. Saudi capital didn't just enter American professional golf. It restructured its entire governance. This is the new world capture the strategy was built around. Taking cash extracted from a depleting natural resource and converting it into equity, governance rights, and cultural leverage inside the exact institutions the West assumed it controlled. Now, and this is the part almost nobody covering this story wants to talk about, because it complicates the unstoppable Saudi conquest narrative, the strategy is not infallible. And the most instructive recent example is 54 Golf itself. By 2026, LIV had become a genuine cautionary tale inside PIF's own portfolio. The fund had poured somewhere in the range of $5 to $6 billion into building an entirely new golf league from scratch, new IP, new broadcast infrastructure, new fan culture, and it never came close to displacing the PGA Tour's decades of accumulated legitimacy, its major championships, or its broadcast deals. Reports in 2026 indicated PIF was winding down its direct funding of 54 entirely by the end of that season after burning through roughly $100 million a month with negligible broadcast revenue to show for it. Why does this matter for the bigger picture? Because it reveals the actual shape of the strategy with far more precision than the success stories do. The Newcastle model, buying a controlling stake in an institution that already has a century of built-in legitimacy, worked. The LIV model, trying to manufacture brand new institutional legitimacy from zero, purely with capital, largely failed. Sovereign wealth, it turns out, can buy control of existing power structures far more efficiently than it can build new ones from scratch. That's not a footnote. That's the whole thesis of this video, confirmed by its one clear counterexample, which tells you something crucial about where this strategy goes next. Not toward building rival institutions, but toward continuing to acquire stakes. And you do not want to miss how this story continues. The strategy never depended on luck. It depended on patience, it depended on leverage. It depended on negotiation. It depended on thinking decades ahead. And that may be the most important lesson of all. The long game often beats the loud game. Quiet strategy can outperform open confrontation. History rewards those who understand leverage, and leverage rewards those who build it patiently. That's the story hidden beneath the oil.